All right, so Grant Abbott speaking, and welcome to this session. This is going to be the second of three this week. Yesterday we had a great little intimate strategy session, and we went through, we started off with a fairly innocuous issue around temporary incapacity and ended up building a temporary incapacity income stream documents, or set of documents, which I've just got a test. I was working on those this morning, so test, and they'll be probably up and running. I'll launch them tomorrow morning at 10 a.m. for our normal session when I'm going to be rolling out the SMSF Death Benefits Trust, and I'll release that temporary incapacity one as well. So, which I thought it was great to actually show you how quickly we can build documents and templates on this system. So we're certainly miles in front of everyone else, which again is useful. That if you do have some documents or templates that you ordinarily use, please let us know and we can build them up on the system. So let's go forward and look at this concept of radical restructuring. Look, things haven't really changed for 50 years or so. I think the first time I got involved in tax, etc., was way back in 1983, and I really got the tax bug at that stage. In fact, the person I was I think the real thing that changed me at that time, although I obviously wanted to be an entrepreneur, but the thing that changed me at that time was reading a book by Peter Klein, who was variously known as the Unartful Dodger, absolutely brilliant lawyer, and certainly a great tax avoider or tax evader or whatever. And I read this book and about Liechtenstein and Stoltz and this and that, and it was quite amazing to me. And I thought, gee, this is great, because the more we can help clients and meet them along the track and minimise their tax, the better things are going to be, because obviously it's a win for us and it's a win for them. The only one who misses out, of course, is the Commission of Taxation. And that sort of devolved for me and built into, obviously, superannuation, which is still probably one of the best tax things going around town at this stage. But mark my words, over the next 5 to 10 years, certainly we're going to end up with I think pension exemptions will be out the window. We'll just end up with a flat rate of tax of 10 to 15%. But, that's in the future. We've got to work out what we've got now and be flexible and malleable. But again, the thing about the self-managed super fund, we love it for tax, but it's pretty useless if you're 40 or 45 years of age, because all your money is in there. You can't expect a COVID to come around every few years and enabling everyone to draw out 10,000 or 20,000. We saw, for example, yesterday, the ability of temporary incapacity to be paid virtually salary continuance or salary amount straight out of your superannuation fund from earnings, reserves, or even member account balances that relate to salary sacrifice. So there's some good opportunities there, but we're fairly hampered. The same way if we have a look at with wills and estates. They look great, fantastic to distribute it across all the family, do the gift giving and all that sort of stuff. But they're seriously open to challenge, which I want to look at a little bit later on. So in fact, I more often than not, probably 50% of the time, when we go down and advise clients, we generally tend to just do a basic will with a EPOA, because everything is used and protected and put up to Family Protection Trust. So the things that has been stock standard before really are now starting to not fall apart. It just means that that they serve their purpose. They're isolated. They were treated as silos and not as a consolidated field. I had a question from Lloyd Harris, who asked me about whether we've got an overarching document like almost like a family constitution, almost like the Commonwealth Constitution. And look, I've been getting my head around it, and for you guys, if you've got any input on that or any ideas, Ian and crew, please let me know, because I'd love to get an all-encompassing document that we can build, and then that's the guide there for the client. And really, the first point of call for them is going to be really what's important to them. When we go through that process of what's important to you, that's really setting down your values. I started this, oh gosh, about 15, 20 years ago, doing life values consulting, which I built a system around that. I must admit it's dropped off at one stage. I'll come back to it. But the key thing there is it's a fairly simple process of asking a client, what's really important to you right now. And I find that the key area, depending on the age, generally, if you're older, it's health's a big issue because we've had friends who drop off, or like me, I've got a bit of a bung eye or whatever. That's an issue for us, and we try and obviously get a lot healthier. What I was listening to last night? Someone talking about being a boomer, and I was on The Voice, I think, and it was a guy who was 60 and actually didn't know what a boomer was, but started referring to himself as a boomer, which I'm right in there as well. So it's quite funny as we get older. Obviously, health's an issue. The other one is ensuring that we've got a secure income stream, and that's during our life and obviously in retirement as well. Part of that, in addition, is then looking after the family. And I know from my perspective, I'm right in that sweet spot. I don't know if it's a sweet spot, but I've got to look after my daughters, my spouse, and I've also got to look after my parents as well. So there's big burdens on the shoulder. But look, I'm not going to complain because, again, I spent a couple of years after I sold out of Now Infinity just roaming around the world, and really it was fun, but it's pretty boring just being retired. And so not that I was ever going to be retired. I wanted to get back in, but had to not compete there. Anyway, the key things really when we start restructuring or when we look at anything is we want to maximize wealth, the client's wealth. Now, I'm not on the first one. Don't look at me when it comes around to investments. I've had some good ones. I've had some bad ones. One thing I always do well is build businesses and sell them for a good price. So I'm happy at that one, and certainly where we're going now with the Lightyear Docs and the Lightyear Group, which includes I Love SMSF. Really happy with where we're going and the system we've got. Just makes life so much easier. Honestly, to be on a session yesterday, and Milton and Ian from Adelaide, my good mates there, we're talking about Dan Butler covering temporary incapacity, which, mind you, I'd only talked about like 8 weeks ago. But then going through the release of that money for temporary capacity, getting a monthly income stream or even a weekly income stream, can't be any more than a month. But importantly, from that perspective, being able to get a tax deduction or a partial tax deduction for those payments or those income stream payments was fantastic. So that was the strategy, and I love getting in that, that. But I've never had a system before where I could then take that strategy, jump onto our system, and then build a suite of documents for that. And the guys will tell you I did it in 20, 25 minutes. That then went off to our hot docs developers, and they came back within 3 or 4 hours and said, look, it's ready for you to review. Now, I'm still going through my mind because I'm working out, well, should I put in a percentage of the deductible amount, etc. So I'm just working it out whether I want to put a calculator in there. But to be able to get that up and running from a strategy to a solution in such a short period of time that's there to make you money and make your business better, to me is, I'm really comfortable about that. But, I've invested in shares and lost a lot. And then, I've had good properties and I've had bad properties. So, everything seems to happen in a cycle. So maximising wealth, look, I can't help you around the investments, but I can certainly help you around the structures. And that really ends up that third point, protecting family wealth is probably more importantly. I've seen a number of people with building up some fantastic wealth only to see it all dissipate under litigation, or if the regulator gets hold of them, so on and so forth. If you have a look at the ASIC, that if you've got a license, and that's why I try and keep out of the licensing rules, particularly around being through the legal firm Abbott-Family, we're exempt from the licensing rules. And really, I'm not sure if many of you are aware, the same with tax agents, you're exempt from the licensing rules as well, provided you do certain things. And there's specific regulations there that enable you to do investment strategies, etc., and not be caught by the Corporations Act. So, but if you are licensed and ASIC comes in and you can see it every day in the feeds that ASIC just closes this one down, close that one, the right recourse, you're going to have to go to the Administrative Appeals Tribunal. So that's like maybe 18 months, 2 years if you're lucky. But in the meantime, your business is shot and you're out of business. So you need to protect yourself. Look at the auditors in Camembert. Look at the auditors in Baumgartner. The same sort of thing is that don't take it a given that the regulator or a litigator or someone's not going to come and knock on your door to attack you. So again, you might have this beautiful wealth, but it ends up getting attacked very quickly. Of course, paying as least tax as possible. I think remember the old Kerry Packer when he was the old goanna or thought to be the goanna in all those anti-avoidance tapes, and he was pulled in front of the Parliamentary Committee, and they were asking typical politicians who don't pay tax anyway, is it why are you getting involved with this, and why shouldn't you pay your fair share of tax? And he just said, look, if you think I'm going to give all my money to you guys as taxes to actually go and waste a whole lot of mugs like you, I think was the word, you got a darn thing coming. The whole thing is to pay as least tax as possible, which all of us essentially want to do, and that's through our structure. And of course, the one that I'm seeing lately, and probably over the last few years, is being able to keep it into the family bloodline. If I took you back 20 or 30 years ago, we've got people who, divorce wasn't a really big thing in those days, but now so many marriages effectively end up in divorce, and of course that can have a really disastrous impact on family wealth, and testimony to that one. But also the other one that most people aren't aware, that if you've been with a spouse or live-in spouse for 2 years, they're actually not deemed, they are treated as a partner in terms of the Family Law Act, and of course, your property is classified as matrimonial property. So not many people are aware of that, but not so much if you're in a stable relationship. But it's what happens with the kids if you end up, giving a child a large lump sum on death, and then find out that can be easily once you receive that, or once your daughter's received that, or son, the next day that their partner, and of course we've got no fault divorces in Australia, next day the partner leaves and says, I'm going to file for a divorce, gets a lawyer, bang, and you're going to find that inheritance just dissipates. So we've got to be very careful. So they're the big things. And look, when you're dealing with clients, that bloodline and protection issue is absolutely crucial. For us, we probably think about tax, but you need to have coherent to tick these 4 boxes off. And that's certainly something that I'll be looking at when we come around to doing that family constitution. Okay, so our radical restructure is to put a moat. First off, we've actually got to help the client build the castle. So the castle here is a whole lot of structures. So we've got one turret here that's outside, so we don't want that. That one is see that one at the far. That's the last place you want to be caught out there if the marauding hordes are actually coming in. So this turret might be, the Family Protection Trust. This is the family here. We've got our SMSF over there. We've got our Testamentary Trust. We've got the Protector there. And then we've got a couple of other things that are all designed to effectively keep our family wealth in there, keep it for the bloodline, and make sure the marauding hordes don't come in. If they do, they've got to come through this crocodile or this infested waters. And particularly if you're looking, regulators are hard because they've got unlimited resources. But if you're looking at a lawyer doing a family provisions claim where there's not many assets in, they're not going to jump in and swim over there if they're a no win, no fee basis. Which essentially at the end of the day is when we're building this, we're not building it the same as obviously the castle and building a moat. We're not building it just because it looks good. We're building it there to protect the marauding hordes come in and attacking it. Now, our historical structure, most of you, I mean, this is base. So when we have a look at it, we've got our discretionary trust, which can be set up, and then we've got obviously our trustee company or individuals as trustees. We've got our bucket company, which is traditional for tax purposes. Obviously, we can transfer amounts out to beneficiaries, but a bucket company, as company taxes go down, we tend to distribute down there, and then obviously use either the money's in there or we lend them back to the trust. And obviously there's Div 7A issues, etc., around that. So that's pretty stock standard. We've then got our SMSFs, and to the credit, there's around about 60% of SMSFs now have a corporate trustee, which is fantastic. And then we've got our wills and our executor. Now, the issue about this, and there are several inherent weaknesses. For example, the bucket company. Look, it's great for tax minimisation, but at some point in time, you actually have to distribute the profits. Now, they'll have franking credits in there, but with those franking credits essentially sitting inside that bucket company, the danger about that is that when it does come out, it's going to be assessable at marginal tax rates than with a franking credit. So it has to come out at some stage. Sorry, I just had to sneeze there. So it's got to come out at some stage, and someone's going to have to pay tax. So you can't keep it going there, otherwise you're just going to end up in this Div 7A problem, for years and years, which tend to just keep on going up year after year after year. So we've got to be very careful about the use of bucket companies. Mind you, there's nothing wrong with that. Likewise, if we distribute down to our adult children, we've got to be careful that those UPEs, again, with our children, they should be secured. So these discretionary trusts that we're looking at here, they shouldn't just be limited to businesses only. I'll look at the family protection trust shortly, but really these discretionary trusts should just be for businesses only. And if they build up equity in them, then we probably need, we're getting exposed there, particularly anywhere you run a business or professional services from, you're always going to be exposed. The bucket company, look, we talk about this as asset protection, but the bucket company has no asset protection around it as a company, unless, of course, it's owned by a discretionary trust, which isn't a bad thing. But then we're starting to build up a lot of discretionary trusts. The bucket company shares, if we had a family protection trust, it'd be fantastic to put that over there. However, for a lot of our clients, you can't just go ahead and do that straight away, because to transfer a bucket company with a whole lot of cash, or even if it's got loans out to various parties, transferring it over into a family protection trust is going to be up for capital gains tax, obviously not CGT. SMSFs, again, we've had a lot of accountants drop off for those, but it's quite amazing. I have seen a lot of a discussion just recently that accountants want to get more involved in SMSFs and moving away from planning. And for those of you who haven't seen it inside our strategy, inside our webinars, I've got a really good session there on what accountants can do, and tax agents, particularly exempt ones, and pull apart the asset guideline on that, which is only it's not even 2 years old now. It's sort of a bit of a hidden gem that no one's ever raised there. And, from that perspective is that there's most of the stuff, with the exception of investments, effectively an accountant or a tax agent can do is not precluded under the law, including if a client comes in and says, look, I want to set up an SMSF, or you've sent out some material to them and they say, look, I love this, I want to set up an SMSF, you can then guide them through the structuring for that. But then it's good for tax, but there's limitations on it. Obviously accessing monies, some good tax stuff going down the track. Or even now, we've got a lot of clients who've got obviously their pension amounts have set up to their maximum T-bar, and they've got even though they're retired, they might be 70, 75, 80 years of age, they've built up a huge accumulation swag at the same time, which is particularly tax ineffective. If we look at if they pass away, that money's being passed out to adult children. then, you know, obviously there's a 17% tax on your taxable component. And, you know, if you transfer assets out and there's, or dispose the assets, transfer them out, there's CGT liabilities there. So it can be quite extensive. Of course, the easy way out that most lawyers will do is we shift it over into the estate. But again, the estate, that's where the family provisions apply. Now, we'll probably end up with an executor who really has no relationship to the trustee company or directors of the trustee company. So we've got lots of stuff going on sitting in there. So they've each got their benefits or their pros and the cons, but then there's no coherent strategy there. In fact, I met someone only a few days ago who's got 3 trusts and about 6 companies, which is pretty tough. As I said, when we have a trustee company there, they can be attacked in litigation by creditors. If I was a lawyer, Tony knows my thoughts and Tony's thoughts, that if we want to attack any one of these ones, then you attack the trustee company. And the issue about that is that obviously you can pull them into any litigation. You may not be able to attack the discretionary trust. We can certainly attack the trustee company, attacking the shareholdings there. And that I've seen that happen a lot of times. And if you can get involved in that, particularly on a family provisions claim, you can virtually grind both of the trust and also the SMSF to a halt. So nothing is untoward. The trust itself is a great asset protection mechanism. The SMSF is a great asset protection mechanism. But if we've got the trusts open, the bucket companies open, then it really doesn't help us whatsoever. And as I said, the discretionary trust, SMSF is problematic, you know, lack of control. So most of the ones I remember years ago, and still to this very day, we see instances where the underlying thought is that every member must be a trustee of a fund. But it's not necessarily the case, because if we have a look at it, every member can't. If I just go out and I'll just bounce out of here, I think I've got some SIS legislation here, maybe if I can get it for you. And I've got the SIS regs there. I just want to show you something and start to really build something here for you. So I'm just going to go SIS Act Section 17A. So that's pretty easy, and it will pop the SIS Act Section 17A. So I actually go to the legislation there. So I prefer the common law. So you can see here on Federal Register legislation, the SIS Act, and then I'll just go down to, oops, that looks as though I'm too far, Section 17. And let's go to Section 17A. I'll just hide this and blow it up a little bit for you. Okay, let's go and have a look at what we've got here. So Section 17A, definition of self-managed super fund. Look, this is what we all know. So it's got fewer than 5 members. If the trustee of the fund is a body corporate, each director of the body corporate is a member. So that's fine. Each member of the fund is a director of the body corporate. So that's been ingrained in our memory. Obviously, if you're a single member fund, then there are some exceptions to the rule, but the best thing is obviously you get the body corporate, or you set up a trustee company with a sole member. But it's down here which is important. So subsection 1 says, look, you must be if you've got a corporate trustee, each director must be a member of the fund, and vice versa. Now, if you read down here, it says a superannuation does not fail to satisfy the conditions by reason only that. So what that's saying is, look, this member trustee rule is basically irrelevant when we have a look at it from that one. There we've got here a member of the fund has died and the legal person representing the member is a trustee of the fund or director of the body corporate as the trustee of the fund during the period beginning when the member of the fund died and ending when death benefits commence to be payable. So what that means is the executor of the estate, remember we saw the will, they can come in and effectively, if you've got a good deed or good corporate trustee, which we have, the executor gets automatically appointed as a director of that corporate trustee, and they're the only ones who can make a decision in relation to the deceased death benefits. And again, that gives us really a strong amount of control for the executor. The other one, which is really important, and I think this is the new style of self-managed super funds. So the legal personal representative of a member of a fund, and I won't go into it, but a legal personal representative is a person who holds your enduring power of attorney, is a trustee of the fund or a director of the body corporate that is a trustee of the fund in place of the member during any period when, don't worry about this, or two, the legal personal representative has enduring power of attorney with respect to the member of the fund. So if you've got an enduring power of attorney in relation to someone, then effectively they don't need to be a director. So if we go back here and we have a look at our slides, so historically, when we go in and we have a look here, that our executor is obviously appointed, but if I've got an enduring power of attorney and I've got a trustee company, I don't need to have all the members being directors. In fact, we should do the reverse. What we should be doing is putting our hands up for control perspective and say, okay, well, who should be in control of that fund? And if they're in control of the fund, then we should be looking at all the members or the minions, so to speak, saying, okay, well, which ones of these are not smart enough, but are good enough to actually act as a director or who want to take that responsibility on. For example, mum or dad who are in the fund, set it up many years ago, getting older in years, may not want to be or may not be in an appropriate zone to be a director of the fund. They'll still be members, but effectively their children who've got their enduring powers of attorney can step in for that. And you can have an enduring power of attorney. Well, most lawyers will tell you can't, but we've built an enduring power of attorney. If you want, you just go through, and if you've seen our EPOAs before, you can build it on light year docs where you just an EPOA for superannuation purposes only. So again, it's getting that control. Without that control, we're sort of in a bit of a void. And of course, the big weakness is around this, that we don't have any advisors controlling the lot. So we've got our accountant that's basically sitting in there. We've got our SMSF, which might be the financial planner or the accountant, but we've got that horrible little hiatus, which is, accountants are too scared to get involved. Planners then don't really understand the tax on the other side. So we're sort of really going a no place. This is like a no man's zone. And then, of course, we've got the lawyers over here who do the estate planning who don't know about SMSFs or discretionary trust whatsoever, and generally don't take that into account. I mean, if for those of you who've had clients going to lawyers around their estates in this structure, have you ever heard of a lawyer ask about what happens with the trustee companies? Who's got the shares? Who owns the shares? Is there EPOAs around the shares, etc.? It just doesn't happen. So there's a lot of weaknesses around that control, so that when we go back, we might be able to maximise our wealth. So if I go right back to the start, we might be able to maximise our wealth. We can probably work as paying as least tax as possible, but we've got no chance in hell of protecting family and family wealth, and certainly no hope in hell of keeping everything into the family bloodline. And you just think about it yourself, when you've set up a discretionary trust, I see so many where we've got one appointor, and then the appointor dies, who then actually looks at this particular structure, who's actually going to control it. And I've seen a number of you, and it's a bit scary, running with trust deeds that date back to the 1980s or 1990s. Really, they need to be upgraded. In fact, many of them that I've seen don't even fit in with Bamford. So I've got no idea how I go through the process of, don't know how they go through the process of, being in a position of being a appointor, making distributions according to Bamford if it hasn't been updated since 2010 when Bamford was around. The good thing about that is Commissioner's got Tax Determination 2012 that says it's not a resettlement. So we should, look, if we're going down this process, we need to get a clean deck. And a clean deck for me is looking at upgrading everything. So we'll talk about that. As I said, the dangerous thing about it is, if I go back here, is not so much the discretionary trust, but we push all the money from the SMSF into the estate. You know, the client's got a house, and, you know, obviously with Australia, you know, most of the boomers or the elder generation, what they call the silent generation, have got quite a bit of wealth tied up in their family properties, not much mortgages. They might have a few bits and bobs, but I can tell you, just going through the process these days of when Mum passed away, she had amazing antiques, but honestly, you just can't give them away. When you've got IKEA and Freedom offering brand new furniture at such cheap prices, it's very hard. You know, those personal effects aren't worth a lot. In fact, you have to pay people to get rid of them. Even the second-hand dealers won't even come out and look at them. It's just crazy unless they're really into that sort of stuff. So the danger there is we might have a whole lot of stuff that's in our estate. You know, we've got a lovely testamentary trusts and all that sort of stuff going on. But the problem about it is that it might be open to challenge. And I've got this out of the Succession Act. This is New South Wales, but Queensland, they're all much the same. And they give the ineligible person the power to effectively go in and attack the estate. And obviously, it just doesn't come up anywhere in their mind. What happens is, if they get a lawyer who gets involved, that's where the fun starts. Because if you've got a decent size estate, let's say it's $1 million, then you know you can ride that out, particularly if the parties aren't really, if they're at loggerheads, which quite often happens. You can ride that out for years, probably 2, 3, 4, 5 years. And if there are loggerheads, you just generally, no lawyers involved want to really get to a settlement. And so it's long-term, fully paid fee work. So, you know, it's a bit of a gold mine for lawyers. Now, what they've got to do is find an eligible person. And as I said, this is very much similar to all the various states. So if I have a look, back there. So an eligible person who may apply to the court, and the court is the Supreme Court. So as soon as you go into the Supreme Court, you know, you might as well just throw 50 grand down on the table straight away, or 50 grand down the toilet. For a family provision order in respect of the estate of deceased person, it's a person who was the spouse of the deceased person at the time of the person's death. And that includes obviously de factos, etc. A person with whom the deceased person was living in a de facto relationship, a child of the deceased person, a former spouse of the deceased person. Now, that could be pretty nasty. A person who was at any particular time wholly or partly dependent on the deceased person. So that's at any time in the past. So that's crazy. And who is a grandchild of the deceased person, or was at that particular time, at any other time, a member of the household of which the deceased member was a member. So if you're a grandchild, if you live with them, effectively, you're right in there as an eligible person, or a person with whom the deceased person was living in a close personal relationship at the time of the deceased person's death. So we've got quite a wide umbrella of eligible persons who can make a claim there. Again, that means it starts to fester outside potentially the bloodline. There's no protection, so on and so forth. So what is a better way? And for those of you who've heard me before, look, it's what I've done is I've built a number of structures around this, and I'll go through them, but they're not overly sophisticated. So ideally, and I'll show you very shortly, we'd wrap around this concept of a leading member around all the structures, including the will, not necessarily the will, but what we do is we'd make sure a leading member is the executor of the will, so they can control everything. Because one of the dangers about an executor, and we've got to be very careful, that you see quite often someone will make their spouse the executor, but I'd never make my wife Amanda executor, because it'd just be way too stressful. She's not a financial person, and if things started to come under attack, then we've got some really, there's some really big issues there. So the executor's got to have like a pretty serious backbone in case there's some litigation coming in. So the leading member, we can effectively build around up on the Light Year Docs site. We can change an existing discretionary trust into a leading member trust if we want to go through that process. A leading member, an SMSF into a leading member SMSF. I'll go through those fairly shortly. So the real focus, though, if you want to nub this out, and this is why it does get simple, is in on that succession side of things. So you'll see when you're doing a data capture, the client does a data capture. The best way to explain to them is, for example, the British royal family. It's hard to get down to anything. For example, when you're trying to explain to someone what a binding death benefit nomination is, it's like, what does it mean? So if you can grab onto something that they can then generalize, or their mind can grab onto and say, well, it is like this, then it makes things a lot more certain. So the British royal family has a definitive line of succession, which is obviously the Queen, Charles, William, and then on to George. So, for example, if Charles happens to pass away before the Queen, and I just saw Prince Philip's just hit 99 today, so good on you, Philip. And but if Charles is not there or is incapacitated, I'm not sure if it really makes a difference if they're incapacitated. Prince Andrew or Prince Edward aren't going to step in, and I think what's the other one, Princess Anne, aren't going to step in and take control. It just goes down to the next heir, the next in line of succession. And that's the same way as we should be looking at when we're building these. So the leading member for our SMSF, which is in our trustee company, the leading member director, likewise should obviously be the initial person who's going to run it. And of course, we ask that question when we start up. So in my SMSF, I'd be the leading member. In my family trust, I'd be the leading member appointor, so to speak. Now, that's great and it's all well and dandy, but if something happens to me, or I die or become incapacitated, or I simply want to move out of there because I'm under personal attack, or I'm under attack from the regulators or whatever, then it's the next in line. And really it's the next in line that's important, because the next in line should be the next leading member or appointor of the trust, discretionary trust, or the family protection trust, which we'll look at. The next in line in terms of the SMSF, the next in line for the executor, so it should be the executor, and it should also be the power of attorney. Now, that next in line could be more than one person. So unlike the, obviously, the British royal family, where they all, it's just one person, we can have joint if we want. But even if we have joint, you'll see when you go through the interview process, you still need to have a stopgap. And so, of course, if there's just joint, say myself and my brother, then effectively someone has to have the binding vote. So we go through that process as well. So that's included in there. So that succession, if you get that down, it's then very easy to create a lot of this moat stuff, because we're leaving everything in control of one or two people, and that's absolutely crucial. Now, we can shift the assets can be shifted to the SMSF for tax purposes, and SMSFs are great for asset protection. If you have a look under the Bankruptcy Act, there's some good things and bad things. So if you have a look under the Bankruptcy Act, I can be a member of a superannuation fund. My trustee in bankruptcy can't touch any lump sums that are coming in. Well, obviously, they can't touch anything in super. They can't touch anything if I was retired or a met a condition of release. They can't touch any lump sum. They can obviously access pension income, because that's obviously the income I'm earning on. There is obviously going to be a limit, not a limit, but you will have some money that the trustee in bankruptcy can't touch, and that will be determined at bankruptcy court. Now, what happens from there, though, obviously you're not going to take a pension, you're just going to draw down lump sums, because they're exempt from, obviously, a bankruptcy. The danger is, of course, in self-managed super funds, very problematical because we can't be a director of a self-managed super fund if we're bankrupt. We're disqualified persons unless the commissioner allows us otherwise. And I have seen that happen in a couple of cases. We can't put enduring power of attorney in there either way, so that doesn't happen. So really, we want to transfer our assets to an SMSF or a family protection trust for both tax and estate planning stability. I'd like to not have anything in my personal name, and I think we've done that in the past. I've seen too many cases where the old school way of things was that any personal assets were protected by being in the wife's name. Unfortunately, so just having a drink there, that doesn't make sense, because if the wife walks away or the spouse walks away, then you're in a very disastrous negotiating position when it comes around to family law. So if it's prohibitive, then we want to use Protector as a gift loan back to get rid of capital gains tax and stamp duty. So the new structure that we want to look at here is, again, so the new structuring is that we've still got our wills and we've got our executor, but there's not much in our estate per se. So I'll leave that to the side. You can see this big red line. We want to make sure there's not much in there, so that when our aggrieved eligible persons come in and say, look, I want my, I've been left out of the will, or the second spouse has, or whatever, that effectively it's like, well, hold on, there's nothing in the estate, so I'm not going to swim, the lawyer's not going to swim in that crocodile-infested waters if there's nothing in there, because it doesn't, if they're working on a no-win, no-fee basis, it doesn't make any sense. So what we do there is we get those assets, and over time we can, and remember that would include the bucket company, of course, and we'd like to transfer that into the Family Protection Trust. Now, the issue about that is if I've got an existing leading member discretionary trust, if it's carried on business or been around a while, it's probably not worthwhile. You can still keep it, but a family protection trust is probably a better structure. I've seen an overlay of a discretionary trust to a leading member discretionary trust, and that being used the family protection. But if it's been around for a while, look, you just can't guarantee it. So when we have a look here, we've got our wills, we've got our executors, we've got our leading member SMSF that will be sitting there, the leading member special purpose corporate trustee. The important thing about that one is that when we have that, we've got a scenario whereby the leading member that we put in place, the first one, when they die, or for example, they're getting attacked, they resign, or they're under a family law, they're obviously in a separation, it looks as though they may go bankrupt or whatever, then they resign as a leading member and director from here, and also from here as the appointer. That means the next leading member basically comes in and takes control from that perspective, which is A-OK, and that's perfectly what we want. But what's the point if we've still got our shareholding? Remember I said a shareholding can be attacked. Well, those shares are then cancelled and the new leading member takes control of those shares. So rather than a transfer, we've actually done a cancellation so that then there can't be any clawbacks, so on and so forth. But effectively the assets that are sitting here that aren't in those, that would ordinarily jump the fence and become part of the will, such as the bucket company, we want to transfer into the Family Protection Trust. And again, the Family Protection Trust is we'd again use a special purpose, and the sole thing there is a leading member corporate trustee. This is again a leading member discretionary trust, but we just essentially call it a Family Protection Trust. Now, when we've got assets that's sitting outside, and including a bucket company, we can't transfer, as I said, the bucket company, if it's got a couple $1 million of loans, etc., in it, or cash, it's very difficult to transfer those over there, because we would have started this up with $0. And if it's already sitting in a discretionary trust, then you should be okay. But we can't transfer it over because of capital gains tax. But we can transfer the equity over in this bucket company into the Family Protection Trust by way of a gift loan back, or more importantly, we can transfer the shares over, or the value of the shares over, into that Family Protection Trust, which is probably a better way. So that we end up tightening up, and remember, executor is going to be, so if I have a look at it, I've got the leading member here, the leading member here, the leading member there. Then I put in place the second leading member or second successor leading member, or we might just call it the successor leading member. And they take control of the Family Protection Trust if they retire, etc. They take control of the discretionary trust. They take control of the leading member SMSF, and they're also the executor and the power of attorney. And remember that second or that successor can also be joint. And we don't leave that. We can also have then second successors and third successors, so that when we start to build this, we build a really long chain of succession, and that's absolutely crucial. And of course, with the family constitution, that would bind it all together. And as I said, I'm still getting my head around that process as well. So when we have a look at it there, so some of the stuff to actually go through and rebuild all of these, you can build those on the site really quickly. So you just got to if you get that succession in place, then you just go and overlay the corporate trustee and the SMSF. You do a deed upgrade with an upgrade of the constitution. And you'll find that that's in our strategy automation on the LightYearDoc site. So that takes no time. Same way the leading member discretionary trust, we go through exactly the same process and we upgrade it. Again, it's not going to be a resettlement at all. Now, the Family Protection Trust, you'll build that anew, and that's just going to be a separate leading member trust and leading member trustee company. You can hold this one as also being the leading member trustee company for that one as well, or you can build a new one from that perspective. And then obviously we've got the executor as well. So when we start to do that, we're going to build our protector. So that's probably the first one to get all the assets. So what I've got to do is have a look at what I've got in here, what I've got in the, not necessarily SMSF, and in my own name, or you'll find in the protector, you can do individuals, you can actually do joint assets. So you can actually take equity out of a joint property and put in there, which is great. You can take equity out of a discretionary trust or company and also put it into the Family Protection Trust. You can put in UPEs from the leading member discretionary trust and transfer those over or gift those over. That's a great strategy for me. Rather than gifting them back to the trustee, gift them over to the Family Protection Trust. Because if you gift it back in here, you know, there's all manner of problems there, particularly if it's a trading company. So it's not hard to actually set all of this up. So set all this up, then you go through and do the protector. Now, then what we need to do is we have got potentially assets are sitting outside. We might transfer the equity in, but we might also be able to transfer assets into the SMSF because there are some rules around deductions, etc., that enable us to transfer the assets into the SMSF. So we can transfer those in because they're also concessionally taxed. Because if I'm just transferring equity, there's not going to be much in there. So I've still got a lot of this stuff here. So if I can transfer assets there and assets from my individual name in, then I'm in a pretty good position. So from that, I mean, obviously we've got our concessional contributions. If you haven't looked at this, go back and have a look at last week's session. But essentially what we've got there is concessional contributions don't have a cap. Remember, we looked through there, effectively they are the excess amount over and above $25,000 is added back to our assessable income in the year in which the concessional contribution hits the member's account. So let me say that again. If I make a $75,000 contribution this year, and it could either come by way of an employer contribution, so that we've got a leading member discretionary trust that makes a contribution on behalf of dad. So we're looking at the parents here. They're employed here. We then make a $75,000 contribution. You don't have to worry about, as long as they're doing some work, the contribution doesn't have to be commensurate with the amount of work that's actually performed. And there's a commissioner's guideline on that one. If we then transfer that over, $25,000, the whole $75,000 if it's made this year and it's allocated to the member's account this year, then effectively that will be tax deductible here and assessable there. Now that could be a transfer of assets, for example, business real property, could be shares, could be whatever goes over. We have to watch out for Section 66. Now the other $50,000 that's gone over, if it's in this income year, it's excess, and then that will be added back to the assessable income of the employee and then taxed at the marginal rate. So if that employee is not taking any income whatsoever, and then just simply doing a full salary sacrifice, then for this income year, if it's dad or it's mum or it's spouse, etc., then in those circumstances, that $50,000 will be taxed at marginal tax rates. And then you'll find with tax-free threshold, LISTO was a low middle income tax offset, what's that, MIDSO, plus obviously the way the add back works, you get a 15% tax offset. Then in those circumstances, there won't be any tax. So you can actually, for those people who aren't paying tax, you can spread around about $75,000 per annum, either by way of a salary sacrifice or a distribution, and they can then make a contribution in, and there won't be any tax payable. You just got to watch out for the tax inside the fund. Now, the older the member, obviously the better, because once you're 60 and conditional release, you can take it out. So you could do this, for example, if you employed a 15-year-old, but then again, you're loading them up fairly well. Now, remember the $50,000, it's only included when it hits the member's account. So that's not a bad one. Again, non-concessional will be excess is treated as non-concessional, but I can put in a large amount of assets basically sitting in there as non-concessional, subject to my general superannuation account balance. You know, if it's over 1.6, I'm limited. But if it's for sale of business or business real property, then I'm sort of protected there. And if I go over my NCCs, remember, are going to be $300,000. If I go over, if I bring that forward, if I go over that $300,000, then I'm just going to have to withdraw that at some stage down the track. And there's not a penalty, it's just that there's a deemed earning on that from the time of the contribution, the start of the income year, the contribution, to when the commissioner comes and says, hold on, you've got to withdraw that. So that extra amount goes into assessable income. As I said, use older members of the family. Max deductibles where you can to transfer assets in. So if we've got a property, we effectively can transfer it in, maximise your deductibles. If there's only so much we can put in, then you can use a related party loan, which isn't a bad thing either. So the year-end contributions case study, I did this last week, so you can have a look, but I've sort of finalised. So I've got a client, 65 years old, an $800,000 share portfolio. That could be in their self-managed super fund, some of the self-managed, it could be in their discretionary trust or in their own name. It's got $400,000 capital gains, so I'm going to transfer all the shares into the fund. So I'm going to contribute $200K concessional contribution this year, so there's no tax in the current income year. So what I'll do is I'll put it all in from that perspective. So the current concessional for the year is $75,000. The rest of the money is going to go into a suspense account. So I've got $400K capital gains, but $200K of assessable. So I'll take the $75,000. Remember, that's the amount that is basically going to be tax-free. The other $200K, so the $125 we're going to throw up into a suspense account, and that will then be lobbed out in July, or has to be paid out by July the 28th. So that's the time it meets the member's account. So that is the income year in which it's going to be tested or it's going to be added back. So for that 125, we've got 25 next year anyway. So it's going to be $100,000 added back to the individual's assessable income for the year ended 30 June 2021. So we're going to have to look at paying tax on that, the same sort of thing that we're talking about before, but it's not going to be payable until probably May 2022. So it's good deferral, but it's also permanent difference in there as well. Now, we have put a lot in there now at the end of the year, and I'm going to be looking at a whole lot of stuff a little bit in a couple of weeks anyway. But with 200K, we're up for $30,000 in income tax. So if you had an ESIC, then effectively you can basically remove that. Put 150,000 in, that's going to get rid of it as well. 100K in this year is NCC. but you've got 50K from excess concessional. So remember, we've got 75, 50K, so I can only put in 50K of non-concessional. The rest I can still put in, so I can either hold it off or I can put it in and carry it through to next year. The good thing about shares is I can actually split the capital gains tax liability if I wanted to do that. I'm just showing you what a radical restructure we can do if it was a property itself. So we transfer it in, and then, as I said, we've put it in the suspense account. The NCC is 3 years draw forward, so I've taken my 100 last year. I've then got 400 I've got another 300 for next year. And then obviously the 25, which was the ordinary excess concessional. So when we have a look at it, we've got the NCC in suspense 300K, then we've got excess concessional of 100. So once we have a look at that and pay it down, it ends up my figures, and don't trust my figures. I'm a lawyer, not a lawyer. I'm a legal person. I'm not. I call myself a lawyer because I never did law. But party to Abbott-Family. So what happens there is the other 350K is a related party loan, and look, that's a really good thing. And this is a good strategy too if you've got property, because if it's business real property, then we might have no tax. It's a good idea to transfer it in, and depending on the state, you might be paying concessional and no stamp duty as well. So again, we can do this radical restructure. As I said, if it's held jointly, you can virtually double it up. If you're under age 55 or even 60, the loan's pretty good because you can access super at a later time. Look, I love business real property. You can transfer it in, but if it's resi property, if it's already sitting in there, not. But if you're going to buy resi property over time, you can use the 1322C trust. In just watch in-house assets. If you've got there, it doesn't matter. I can transfer in-house assets in and then leave them in there. For example, a lease of whatever going back to the related trust or related company. Just watch out section 66. But if we've got someone who's old, then you've moved all this in, and then you go and start a pension in July. So it's a pretty sweet deal that we're having a look at. And to me, that's, look how much tax I'm getting rid of there with 800K share portfolio. And that now means it's sitting from outsiders now into my SMSF. And you'll see tomorrow, obviously, if someone dies, we want to make sure that's got an auto reversionary pension, which I would have done. And if there's any excess accumulation, then what I do is I use my SMSF Death Benefits Trust. So I'll render this and I'll put this up on YouTube, and this will be available to you a little bit later on. Of course, if you need any questions, just come to myself or my daughter Sophia. I love SMSF.com. Tomorrow we're going to be looking at SMSF Death Benefits Trust. I'm going to take you through the testamentary trust provisions under Section 102AG of the Income Tax Assessment Act, and show you how you can build a death benefits trust straight over an SMSF and still get all those tax concessions, much the same way as is done with a testamentary trust. But it means that it's effectively protected, obviously, from it's going to be protected from family provisions claim. When we go in again, the Virtual Strategy Summit, I'm doing that with Tim and a whole range of people. So it's for accountants and financial planners. There's lots of tax strategies, business strategies, marketing, etc. That's on the 14th and 15th of July. All you guys will get effectively no cost for that, but you're going to get 11 hours CPD. So, and there'll be lots of professional and corporate stuff there. So you're going to get a really good start to the year for that one. So watch out. It's a virtual summit, so it'll be evolved. And we're actually going to have a cocktail party for that. So it'll be a lot of fun. We've got a great cocktail bar. I'm going to come in and teach you how to make some gin and rum drinks. So you just got to stock up your bar and we'll be having drinks together. And again, don't miss out on that Tuesday 11 a.m. strategy session. If you'd like to get involved, just have a chat with Sophie and put your name down. We can only take 20 per time, but I'm going to build that up over time and just bring any client case or whatever, and we'll have a lot of fun. So it's certainly one of my best sessions. Tim, where do you get good rum from? I love, there's a lot. Actually, you can get it from my brother, Chris. He makes his own rum, so watch out if you like some rum. Anyway, it's enough from me. Thank you all for turning up. It's Grant Abbott, signing off.